pension and inheritance rules are notoriously complex, and that results in misunderstandings, misconceptions, and that might mean that the family get faced with unwanted inheritance tax bills, perhaps missing out on opportunities to protect the family's wealth. And this is going to get a whole lot more complex in a year or so when the new pension rules come in, where pensions will form part of your estate for inheritance tax purposes. So I thought today we'd take you through 10 common misunderstandings, perhaps put the record straight on those misunderstandings, and I'll also take you through some of the areas of potential advice that can help anyone looking to organise your estate in the most tax efficient way. So the first misunderstanding is that only the wealthy pay inheritance tax. Now this might have been true 40 or 50 years ago, but it's become a lot more of a mainstream tax now. You know, property prices in this area of Bristol will take up most, if not all, of the inheritance tax allowances. And now with pensions coming into estate planning is a significant change. It means that anyone really with a personal pension, self-invested pension plan, perhaps a company pension that you've built up, with those forming part of your estate for inheritance tax, it means that your average person definitely needs to review your financial plans to see whether you have a potential inheritance tax liability. The thresholds have been fixed since 2009, would you believe? The individual allowance, the 325,000, has been fixed since 2009, so it's not a lot of money before you have to start paying 40% inheritance tax. So it's a definite myth that it's only the wealthy will have to pay inheritance tax. The second one is gifting assets automatically reduces inheritance tax. So whilst it's true that gifting to outright to family members, or gifting to a trust, or gifting out of income, or making charitable donations, they're all valid strategies for inheritance tax planning. But usually if you're making a gift, you have to survive a 7-year period before that gift comes out of your estate completely. After 3 to 4 years, there's a tapering process where any inheritance tax still due will be reduced. But if you do die within that 7-year period, effectively your gift comes back into your estate for inheritance tax purposes. So gifting doesn't automatically mean that your inheritance tax is reduced. And by the way, gifting, some of the rules around gifting can get quite complex, especially gifting out of income. Obviously trusts, gifting into a trust, there's lots of different choices there. So it's not quite as simple as gifting and then reducing your inheritance tax. Number 3, your spouse automatically inherits everything. Unfortunately, that's not the case. Without a valid will, basically the government decides where your assets go after you've passed away according to the rules of intestacy, which are set rules where your assets are directed to different family members depending on the amount and who they are. And so without a will, it means that your assets might not get transferred how you want them to be in the most tax efficient way. If you want your assets to pass to your spouse using the spousal inheritance tax exemption, you need to get a valid will in place. So your spouse definitely doesn't automatically just inherit everything. Number 4, giving your house away removes your house from your estate for inheritance tax purposes. Unfortunately, unless you're paying a market rent, that's not going to be an effective strategy. If you're still living in the house, it means that the house comes under the rules of gift with reservations. So it means that basically your house will still come part of your estate for inheritance tax purposes. So they've closed that loophole, unfortunately. So unless you're paying market rent, which is an unrealistic amount in most cases, your house will still form part of your estate for inheritance tax purposes, even if you give it away. Number 5, inheritance tax is paid automatically. Actually, it's the executor's job to, it's the executor's duty to pay the inheritance tax, usually before grant of probate. This has become more of an issue recently with the 6 months deadline to pay your inheritance tax. With assets which are subject to inheritance tax, like property, like pensions in a year's time, these are illiquid assets. So it's meant that it's becoming more and more problematic to pay the inheritance tax within the time frame. And with the interest rates on any unpaid inheritance tax running at base rate plus 4%, it's becoming more and more punitive. What I would say is now these new rules are coming in with pensions, it's making dealing with estates even more complex. The government are consulting on how this is all going to work. I don't think it's particularly clear yet on how inheritance tax on pensions is going to work and how that's combined with the rest of the estate. All I know is it's going to be a lot more complex and a lot more difficult. So it's incorrect to assume that inheritance tax will get automatically paid. It's the duty and the role of the executor to do that. And I can see advice around that only increasing with the new rules coming in next year. Number 6, assets held abroad aren't subject to inheritance tax. That's a myth. So if you're domiciled in the UK, it means that your worldwide assets are subject to inheritance tax. Sometimes there might be countries that have double taxation agreements with the UK, but the first port of call is that if you have assets around the world and you're domiciled in the UK, that will be subject to UK inheritance tax. Number 7, you can pass on £1 million of assets tax-free. So this isn't a given. So whilst it's true that if you are a married couple and that you have children and that you've set everything up tax efficiently in your will and you claim all those allowances through the probate process, that a typical married person with children can claim £1 million of assets tax-free. That isn't an automatic right, and you have to claim those allowances through the probate process. You have to have children, you have to have certain it needs to be aligned in the will, drawn up in the will correctly to claim those extra allowances. And also, if you have significant estate over £2 million, you start to lose that extra allowance on the house, the extra £175,000 on the house, if you have assets over 2 million or estate over 2 million. So it's not an automatic right. So it's a myth to say that you automatically get £1 million as a married couple tax-free. Number 8, pensions are exempt for inheritance tax forever. Unfortunately, up to now, it has been a very tax efficient, valid strategy that if you've built up pension pots through your lifetime that you perhaps don't use, you can transfer those pots tax-free through the generations. It's been a very effective strategy up to now, but these rules are changing from April of next year. It basically means that pensions are going to form part of your estate for inheritance tax purposes next year. So it all change from next year, and unfortunately pensions aren't going to be exempt from inheritance tax. Number 9, some people say your pension dies with you, or it's the will that directs where your pension asset goes to. So personal pensions, self-invested pension plans, any pension pots don't die with you. They transfer to future generations to your beneficiaries, and that transfer is done according to the pension's own nomination form. It might be called an expression of wish form, and this has nothing to do with the will. So this is completely separate. The pension providers will have their own forms, so it's really important that those nomination forms, those pension nomination forms, are in line with what your wishes are. It's in perhaps aligned to what the will's telling you, and are as much tax efficient as possible. So make sure those nomination forms are up to date. Currently the pension death process is completely separate to what's said in the will and probate and what have you. That will change next year to make it an extra level of complexity for dealing with probate and dealing with the people's estate. But remember, just remember that the nomination forms are outside what's written in the will currently. Number 10, you can invest in business property relief investments or AIM shares to reduce or eliminate eliminate inheritance tax. So whilst true that you can invest in anything that qualifies for business property relief, that is still effective for inheritance tax purposes, but you do have to live 2 years for that in order for that to be effective. It's not a guaranteed relief. It's quite a complex area. It's definitely not something that you want to do it yourself. You want to go through an advised process, a robust process, that you're dealing with investment providers that are highly skilled and specialised in this area, because it would be considered a higher risk investment area. So you need to make sure that whatever you're doing is part of an overall financial planning strategy and you're not taking undue risks here. Also recently they reduced the relief on inheritance tax down to 50% relief for AIM shares. So just bear in mind that you're not getting the 100% relief anymore on those AIM portfolios. So in short, it's really important that you're not relying on outdated understanding or ideas of what the rules are, especially now that it's going to get a whole load more complicated next year with the pension rules changing. I strongly recommend that you take specialist advice in this area. You know, this is an area that we deal with clients in later life, more complex financial planning, inheritance tax areas. So strongly recommend that you take time and sit down properly and talk through what's important to you and your plans. In terms of areas that you might want to start looking at, an advisor will start looking at your overall assets and your current situation. What's your current inheritance tax liability? What's your overall financial plan, including all different aspects of your financial plan, whether that's care planning or investment income or retirement income or inheritance tax planning, what your family goals are. So an advisor would really be able to help you get a good clear picture about the current situation, about what you're looking to achieve in the future. We'll review your gifting strategy, whether that's gifting into trust or gifting outright or gifting out of income. We're making sure that not only any gifting strategy is effective for inheritance tax, but also in line with what your goals are, making sure that the people are benefiting, that you want to benefit from your assets, and that's a robust strategy. We will look at some of those inheritance tax planning strategies with you, whether that's investing for inheritance tax planning, whether that's looking at business property relief, whether that's just looking for to make sure that any financial plans that you're making are effective for inheritance tax planning as part of your overall strategy. And we'll also make sure that any wills that you have are aligned with your pension nominations to make sure that all of the inheritance tax allowances and reliefs are being used in terms of your estate plans and for the family. So a lot to be kind of looked at with you. We are doing a face-to-face events in the end of March. We're doing a number of events actually, and these are a great opportunity to listen to me take you through a lot more of these solutions in a lot more detail. There'll also be the opportunity for you to ask questions about your own personal circumstances. So there'll be quite a lot of interaction with these workshops. They do tend to get booked up quite quickly, so I would strongly recommend that you reserve your place as soon as possible. To reserve your place, telephone us on 0117 3636 212, or you can email us at community@haroldstevens.co.uk to reserve your place. And just to give you the details of the events, so we're doing one in Thornbury, the Swan in Thornbury on Tuesday the 17th of March, 10:30 a.m. to 11:30 a.m. We're doing one at St Peter's Church in Henlees. That's Wednesday the 18th of March, 2:30 p.m. to 3:30 p.m. And we're doing one at Stoke Lodge in Stoke Bishop. That's Tuesday the 24th of March, 4:30 p.m. to 5:30 p.m. So reserve your place. It'd be great to see you there. If not, thanks for watching, and we'll see you in the next video. Nice to see you. Cheers. Bye.